Blue Owl, okay, plunges to 2023 low after blocking exit from fund. Okay, so let me read this to you. I know, Jeff, you and Tom both have a lot to say about this. I'm going to come to him. We'll wrap up the podcast with this here. So Blue Owl Capital Inc. shares have fallen to their low since 2023 December after the alternative asset manager restricted investors from redeeming capital from one of its oldest private credit funds. Shares dropped almost 6% on Monday, closing at 13.78. The firm announced earlier this month that it would merge its $1.8 billion non-traded business development company, Blue Owl Capital Corporation, II, with its $17.6 billion publicly listed vehicle, Blue Owl Capital Corp, or OBDC. But investors in non-traded fund won't be able to redeem their capital until the merger closes, which is expected to happen early next year. Investors in the acquired vehicle will swap their holdings for OBDC stock. That means they could see paper losses as much as 20% if the deal closes at current share price, given that OBDC shares are trading at much higher of a discount compared to the value of the fund business. Jeff, thoughts on this story?
There is a growing problem in what's called private credit or shadow banking, whatever term you want to talk about it. It is potentially, it could, if it continues to go in this direction, it could turn into a financial crisis. And the reason is because a lot of this private credit, without getting into the deep weeds here, it's just a source of relending in the economy. So you have these investment funds that borrow, they get seeded by wealthy investors, a lot of hedge funds, things like that. They borrow in wholesale markets like repo to leverage up the returns. And it's basically these investment funds, these private credit shadow bank funds are blank balance sheets. They've been heavily involved, huge volumes over the last several years because the regulated banks haven't been lending in risky sectors of the economy. So private credit funds have been absolutely banging the table on volume, and credit growth without really paying a whole lot of attention to the fundamentals, to the underwriting. Underwriting has gone by the wayside here.
There's that word again.
Yeah, exactly. And it's a very important word. I mean, we see this in every credit cycle in human history. You know, greed takes a hold of everybody. You rationalize away the risk, all the kind of stuff of all the bubble behaviors that we associated in 2008. We're seeing it again here in 2025 in private credit. So what that could potentially lead, what's really happening is there's a lot of losses because there was a lot of dumb lending that took place over the last several years as they were voluming up and growing and whatnot. We don't know because it's sort of in the shadows. We don't have a real idea of what those losses might actually end up being, and of course that feeds into mistrust in the marketplace, and it could from there potentially spill over into something bigger. So what we're trying to figure out is how many losses there are and who has them, and if there are enough of them, who is going to end up paying the bill. The problem with that process of a downside of a credit cycle is that it can spill over into the general marketplace, where if there's not enough information, and believe me, there is not, then people just say, screw this, I want my money back. This is what happened in the earliest stages of the 2008 crisis. And I don't want to I'm not making a comparison to 2008 in any other way than that's just the process it takes. What you had a bunch of hedge fund investors that were earlier exposed to subprime mortgages and really subprime mortgages that looked a lot like this, securitized structures and whatnot. You had hedge funds investors that said, I don't know what's going on here. I'm not getting any answers from my fund managers. They're not telling me the truth. All I know is that there's fund guys over here that are losing tons of money. I don't want to be one of those. Give me my money back. So what you had was a bunch of hedge fund redemptions hit the marketplace, which then created a cascade of selling that became the 2008 crisis. So what we're seeing here with the Blue Owl story is the latest in a series of escalations moving in that same direction. It started with Tricolor, then it was First Brands, then it was, a couple of small regional banks that were exposed to First Brands, then it was Primalend. Then we started getting notice from UBS. UBS said we're shutting down a couple of our hedge funds. Why? They started getting hit with redemptions. And so this Blue Owl story is, again, the same thing. Hedge fund investors are saying, give me my money back. And these funds they're not even exposed to the bankruptcies that we see so far. And so what that potentially tells us is that the investors in these institutional spaces are getting cold feet about the entire space. And if that's the case, then you have what started out as potentially a credit crisis starts to become a liquidity crisis.
Tom.
Well, exactly. And now for everybody that was listening to that, I'll give you an easy visual. In the movie The Big Short, you have the wealthy individual, I forget what his name was, comes in and sits down with Michael Burry and says, we want to take our money out. you can't do that right now. I'm freezing all withdrawals. He says, Michael, you can't do this. I want my money back. I'm calling my attorney. Remember that whole interchange? That is exactly what we're talking about here. And Blue Owl was trying to merge things together. They were literally trying to build the Jenga that was built on the table in The Big Short, where they talked about all this, because they were trying to take Blue Owl 1 and Blue Owl 2, put them together so that they could have diversified risk. And they said, you can't do a redemption while we're putting this together. Well, then guess what? Then the merger broke. They couldn't get it together. They couldn't get all the approvals they needed, so it stopped. Meanwhile, we covered Tricolor last week on used cars, where they found that the asset value of all the used cars that were out there was less than the value of the subprime auto loans here, which is why everybody was saying, oh, it's all subprime, but it's not. Now you have this happening. And by the way, U.S. regulators have fired the first shot, and it's called HPS Partners. HPS Investment Partners, they're a private credit arm of a company called BlackRock, and they're responsible for running highly leveraged but high returns. So their charter, go find things that maybe might be untenable for other people, will be smarter. So they put $400 million backed by receivables. The receivables of the companies, Pat, appear to be fake future sales.
Wow.
So now BlackRock's got HPS going, wait a minute, these guys lied to us? The telecom guys lied to us?
And they never checked.
So now
That's
BlackRock is like, and BlackRock's going to saying, it's not us. It was a division of us at arm's length that we call HPS. Baloney! It was you. It was HPS. You knew them, but you've deliberately set it up to keep some distance there. But now the federal investigators are coming in here going, hey, you 18-year-old college boys got beer in there. Are you having a party you shouldn't be? And so that's the knock at the door. So what we're seeing here is some things out there. When times get good too long, Pat, what happens? People get sloppy. You've talked about it. You've talked about it so many times in the businesses that you've ran, that I've watched you, and that I've sat next to you and watched you run them. When things get really good, sometimes that's when people get sloppy or get a little careless or cut corners. Ladies and gentlemen, your private capital market, and it's coming.
The problem is that the private capital market is huge. It's gotten to be really huge, so it actually can impact a lot more than.
And why in 24 did BlackRock agree to acquire it? They wanted the return. So you guys have figured out European telco, and you figured out how to get some of the bonds on the equipment building they have there, and you've done this? Yeah, I'll give you $12 billion for that whole stack. That's what they did. Now U.S. investigators are going back going, wait. You're telling me some of this was fake receivables and sales that didn't exist? So BlackRock's going to say,
not catch
I
that?
didn't know that.
Yeah.
You were a bad underwriter.
Yeah,
Exactly.
Where's your diligence?
Nobody wanted to underwrite. Everybody wanted to do, it's bubble behavior. Everybody just wants to get the
want the
deal
$12
done.
billion because I need the return.
I don't care about
the red
dice.
light on
We
diligence.
know personally, we know a company that is at that 7-year mark of having raised a ton of money, and those guys are coming saying, hey, we need that money back. We need that money back. We don't care how you get it. We need that money back. You've reached that moment here. Did you have any thoughts on this? I'm going to go to the Tim Cook story.
No, just quickly. I think we're like, it's crazy to me that nothing's happened in the last 15 years where that's been this like great growth in like the stock market and asset prices. So like, I'd be shocked if something didn't give eventually. So like, just like you're saying,
if you got big plans for 2026, I am telling you right now, I can't tell you how many conversations we're having about business planning. There's a reason why we went less than 22 hours to Dallas and come back, because we want to see exactly what's happening with 2026. We're planning for our family, for our businesses, ourselves. And if 2026 is a big year for you as well, I want you to watch this clip. Rob, can you go to the clip with the Jenga to show them what happens when it comes onto business plan and how all of these things are necessary? Go ahead, Rob.
Business is a lot like Jenga. Every piece matters. You need a vision. Do this carefully. You need capital. You definitely need capital. Let's put this here. Listen, hanging on one piece here, by the way. You need the right team. For sure.
This almost fell off, by the way.
You need sales. As good as this looks, if your foundation isn't built on a good business plan, you know what happens? The whole thing crumbles. If you have big plans for 2026, on December 12th, I'm hosting an event called the Business Planning Workshop, where all day we go through the 12 building blocks of writing an effective business plan. So this doesn't happen to you. If you haven't get registered, click on the link below. Let's spend an entire day together on December 12th. Looking forward to seeing you there.
Folks, click on the link below, get registered. You can watch it with your friends, family, and this is going to be people watching this from 100 plus countries, and you can find a way to just get registered at the lowest level, or you can find a way to be on the screen so everybody can see each other, and at the end we'll do a Q&A for 90 minutes. If you enjoyed this video, you want to watch more videos like this, click here, and if you want to watch the entire podcast, click here.